Hi, and welcome to the Purposeful Banker, the podcast brought to you by Q2 PrecisionLender, where we discuss the big topics on the minds of today's best bankers. I'm Alex Habet, your host for today. So I figured I would kick things off by going a little bit behind the scenes. I tend to do that, if you haven't noticed, in recent episodes. But, after, the team collectively sat down to prepare for the show, we made a little bit of an audible. We called an audible pretty much late in the game. We said, let's scrap the idea that we had on the table and let's refocus on the market. Rather than lump in one of our market updates as part of another episode with this, perhaps an unrelated topic. You might have noticed that in recent shows, when you catch these commercial market updates, despite there being a lot of news, the activity wasn't changing from episode to episode, right? We were seeing a lot of strong resiliency in the data. There was elevated volumes. The profitability was there. There was healthy pricing taking place, for lack of a better term. But as every other subsequent rate hike came in, we were finally expecting to see some new anomaly or change come in on the data front. But it wasn't happening, right? We were just seeing the same trends. They were strong trends, but it was the same trends. And, frankly, we couldn't justify putting yet another episode out that had pretty much the same moral of the story that you've been hearing. It wouldn't have been a very exciting podcast episode. But alas, we have some bucking of those trends. And so rather than tack on a market update on that unrelated topic of an episode, we said, let's focus on the reaction that we are now observing with the latest moves. But even more importantly, we want to talk about how we should think about how we're positioning and bankers are positioning their books of business in light of the insights that we're learning from this data. And what better way to do that than to invite the deal doctor back to the show to help us unpack that info? That's right. I made a promise internally to more than one person to see if we can make that nickname stick. Hope that's cool with you. Tony Hernandez, Q2 Senior Solutions Consultant. Welcome back to the show, AKA the Deal Doctor.
Alex, thanks for having me. And with that nickname, I'm starting to feel like Dr. Nick from The Simpsons around here, Do you remember him?
Oh, classic. But, let's just hope you're a better practitioner than Dr. Nick was. Well, Tony, thanks again for being on the show. I said, I think at the end of the last time we recorded, he was like, probably won't be too long till we saw you. So it's been pretty much just a month. So thanks for coming back on. And actually, since we last met, there has been some news, right? I mean, I wasn't in the opening remarks suggesting that there was a lack of news. I was suggesting that there was just a lack of new reaction to the data, at least that we have visibility into. But since we last talked, there's been another rate hike, 75 basis points. They're obviously continuing on this reversal of easy money policy. But one thing I will point out is it was a 75 basis point hike, right? If you recall the last one not too long ago, it was I feel like our Slack channels were catching fire, people were just so abuzz about that rate hike. And then in this last one, it was crickets. I don't know. I guess it's 75 basis points is I guess normalized now for all intents and purposes. It was a unanimous decision by the Board of Governors, the fourth rate hike in 5 months in response to generationally high inflation. It's 40-year high in inflation. So interesting thing that started to happen, right? Equity markets were rallying, right? And a lot of people were starting to question, well, what's driving that? There was certainly no indication in the Fed's minutes or, in any of the public comments that there was going to be any easing of this path that they're on. But something was happening, and it prompted a few institutions like Morgan Stanley and BlackRock to really intentionally publish their perspectives on this. So I'll give you an example. Lisa Shallett, who's a chief investment officer for the advisory group at Morgan Stanley, said that despite the indicators pointing to a softening on inflation, right? The gas prices are down. There's it's actually down, I think, every day this summer, which is fantastic. The commodities are in bear markets. There's there's a lot of things going on, but we have not yet felt the full impact of a lot of these new policies. That the Fed has to simultaneously manage the rate hikes while at the same time reducing the size of its balance sheet, which is, as she points out, uncharted territory. But most of all, there's just a ton of unknowns, right? I mean, think of these unique headwinds, right? The conflict in Ukraine, the Chinese economic recovery, and frankly, how we're learning how to deal with, which is still confusing, how to deal with COVID, here at home. And then add to that there's just a strong labor market. Ultimately, it's good for people like you and me, Tony, right? Or people looking for work out there. There is a strong labor market, and that's of course going to have a downward pressure on profitability. But again, these sort of things, could also be read as a soothing of the fears on recession, right? But, the Fed, ironically, might have to do more ultimately to tame the prices, right? So, according to Reuters, the inflation worries motivating the Fed will only be heightened by the recent jobs report in July, which is 528,000 jobs in July. I mean, what do you think? What do you think about all this so far, Tony? What's your kind of gut reaction, being an observer yourself of what's going on in the market?
Yeah, I think it's quite a change from the headlines that we were getting, call it February, March, perhaps into April. And on the headlines, I remember there was we need to prepare for the hurricane that's coming. And maybe it is very, very similar to tropical storms, right? Where this one, maybe they're thinking that it's not going to be a category 5, right? Maybe there's still the potential for something to happen, but perhaps to a lesser degree. So to your point, I think that there's definitely been a softening on the tone. And with some of the updates that we'll share here, I'm hoping that we're able to illustrate that point there.
Yeah. I'm just really glad that we didn't get in the business of predicting this stuff, because like even a month ago, I don't think we would have said some of what's going on right now. So again,
Definitely
the equity market is kind of seeing what it wants to see. There's strong data indicators that things are starting to work, maybe, and that. But some are saying, well, maybe the aggressiveness will be toned down. But true watchers in the space are pretty much in agreement that the opposite is true, and the Fed will have to continue aggressively. One last thing before I end my prelude rant here. It's important to call out that just a couple of days ago, on August 16th, President Biden signed the Inflation Reduction Act, which is a $430 billion package aimed to reduce the deficit over the next decade by $300 billion. Now, what's interesting about it, given the title of the legislation itself, it actually targets a wide array of policy changes, including things like the subsidies for Affordable Care Act, climate and energy incentives, initiatives, prescription drug price reforms, and the closure of some really popular, let's call it, tax loopholes. But then some do argue that the inflationary fighting effects of this legislation won't actually be felt for quite some time. Some say maybe 2 or 3 years. So it's pretty much we're going to have to leave it to the Fed to be, the main quarterback in this whole battle, right? So let's shift gears a little bit and let's talk about, in light of all this macro level events, we got our latest reading from, our commercial banking data set, the largest on the planet, might I add. And Tony, before we dive into some individual points of interest that we're observing, what's the big picture? How would you summarize it in a few seconds about what's going on?
Yeah. At a very high level, the surge in volume that we've seen this summer has taken a breather. I don't think it's anything to worry about just yet, but it's a change of pace nonetheless, and we'll get into that. Second, and following the ongoing rate hikes, short term indices have risen and are accompanied by longer term rate inversions. And third, we're starting to see evidence that liquidity costs have been trending higher, and these are very interesting, particularly as we're looking at the trend of what's going on in the fixed rate environment. And we also observed some compression on fixed rate spreads, while floating rates have continued their upward trajectory. So I think that if we go back to the conversation we had a month or so ago, there's still some opportunity for our bankers to be creative and kind of or set the pace when it comes to how they go to market.
All right. Well, good. That's what we want to hear. We want to be able to at least say, hey, here are some options versus, just, hey, you're kind of backed into a corner, right? Well, so let's dig into those volumes first, because that was actually, I don't know, it's a very simple one to kind of analyze. But I was just, keenly watching it the last few months, just at how elevated our volumes have been. I mean, it was incredible. So what's going on there? What's the update?
Yeah, and I want to kind of preset that I'm hesitant to call it a drop, right? But it's definitely a change of pace. So to really help us illustrate that point, let's establish a base of comparison. And let's use July of 2021 as our anchor for that. So to remind everyone that starting in March of 2022, that is really when we observed the volumes rally and start to grow. So for those 4 months from March to June, the index run rate was of 143. So think July 2021, $100, call it loan. During those 4 months, it was more like $140, all else being equal. Now, and now this break could be caused by many factors, inclusive of deals working through the system, perhaps a summer lull, etc. But looking at July, our index is clocking it at a 130, right? So $130 loan. And exactly like you said, we're not in the business of predicting. So we'll be keen to continue observing to see if this becomes a trend or if it's reversed as we really go into high gear into the third and fourth quarter to wrap up 2022.
Yeah. So, when I was looking at this number, and you hesitate to call it a drop, by, I guess, a more historical standard. I had, and I wasn't the only one. We talked about it openly here that this, the elevated volumes perhaps were due to, panic buying, let's say, with the anticipation of higher rates. Maybe people or businesses were wanting to lock in, right, some loans at a lower rate. And maybe we're now just starting to see some of that rush taper off, perhaps. Or so, anyways, I guess we'll continue to watch it, and we'll probably try to investigate that a little bit further to see what kind of drove that swell that we saw over the last few months.
Absolutely, and I think that you see that many times happen, right? When the interest rates start to go up, if you had a borrower that was on the fence of do they do something now, do they pre-fund certain projects, that might just be the push that they need to go ahead and lock up that financing before the costs really start to skyrocket. But to your point, there's a lot of factors that go into that. So excited to see how that all plays out.
Yeah. So let's now shift to maybe some of the rate-oriented things that we're looking at. So you mentioned a little bit about fixed rates, and I think there's been an interesting observation lately on the coupon trend. Finally, there's kind of a little bit of a buck there. So why don't you just dig into that a little bit further?
Yeah, definitely a break in the trend there as well, whereby the funding curve decreases on those longer terms, reduced rates in July compared to June, giving way to a reduction of 9 basis points. And this paves the way to that convergence over the past months across the various structures that we follow here. Previously, fixed rate coupons led by about 130 basis points, which is quite steep. Where now we're looking at about 50 basis point difference. And that's that's big. I'd call it a drop, right?
Hmm.
And that's primarily led by prime and SOFR-based loans showing higher coupons month over month, overall tracking their underlying indices. Um, that's all to say that these structures continue to respond to the changes in their underlying indices, and as part of that, the coupon is reflecting what's happening in the funding cost. Quick note on mix. July showed virtually no change compared to June, with SOFR structures at 33%, fixed at 32, prime at 15, and swaps holding at 6%. Now, quick note on fees and SOFR. Particularly, the SOFR structure showed an increase in borrowing cost, not only in increasing the spread, so that more of that direct profitability to the bank, but also increasing the fee amounts and increasing those yields to 79 basis points higher than June. This led SOFR to that 50 basis points lower than we're seeing on the fixed rates, and again narrowing that 130 basis point gap in June. I think the point here to make is that bankers are flexing their strengths on these structures. And you may be wondering, well, kind of what's our take? What should we read on this? Well, bankers have expanded pure SOFR spread just by 6 basis points alone in July to 251 basis points. And to me, again, this expansion demonstrates that eagerness to protect profitability and returns and leaning into the credits that make sense depending on their bank's risk appetite. And again, I think it warrants that we state just how well SOFR has been adopted since the inception. Bankers have not really missed a beat on this, and do continue to win where possible.
Yeah, I mean, that's definitely, as we meet and talk about some of the stuff as insiders here, I think on several occasions we've kind of heard cheers at how well SOFR. I mean, do you remember, maybe like a year ago? I mean, Tony, you and I, we meet with banks for a living, and it felt like there was no movement happening on SOFR for the longest time, or we were just like waiting to see what everyone else was doing before they actually did anything. And look, we both worked in a big bank before. We kind of in the back of our mind just realized, hey, this is probably just going to become some fire drill based on the lack of urgency that we were observing kind of on the surface from where we are. But it turns out everything, look, I'm not suggesting there wasn't any fire drills and stuff like that. Obviously there was, but at a macro level, and certainly at the, when we look at the quality of the deals coming through the system and the structures and the profitability behind them, it's a really positive story to tell about this transition. I mean, wouldn't you agree?
100%.
Yeah.
And look, I think it does pay to be prepared. But to your point, late 2020, early 2021, it was almost like popcorn, right? Like every other week or month, it seemed like that there was a new alternative reference rate that was introduced. First, there was SOFR, then there was BSBY, Maribor. And it just seems like everyone was trying to rush to come up with the replacement.
Right.
Now, we kind of had a Hail Mary pass with SOFR also creating term SOFR that more closely resembled or allowed banks to resemble a LIBOR-like structure that everyone could kind of rally behind without introducing too much complexity to what can already be a complex loan agreement, and also makes for an easier conversation with their clients. So overall, I think a win for the borrowers and a win for the bank on that.
Yeah, you mentioned term SOFR, I guess, versus overnight SOFR. Just an interesting article that was, we have a little channel on our Slack here where people just pass around, interesting or geeky, banky articles. And one that just happened to cross by yesterday was really interesting. It talked about the hedging strategies, with SOFR. And distinguishing between that and also, with term SOFR, how there's kind of a forbiddance on hedging that, and as a result, it's become some of that added cost because the banks are bearing all that risk. They're passing it on to their customers, right? So, On the one hand, overnight SOFR, the activity, I believe actually on the derivatives have surpassed those linked to LIBOR in June, which is kind of like a big deal. I mean, I feel like that's a milestone that we should be talking about a little bit more. But then now you're kind of comparing SOFR overnight to whether you want to do that or go with a term SOFR structure where it's a little bit more predictable in terms of what your expenses might look like, months out. But given that it's more expensive for the borrowers, are they going to start to look elsewhere? I mean, if you think about a term SOFR structure, for a big ticket item, let's take a $1 billion ticket here. When you're talking about 3 or 4 basis points higher versus the overnight SOFR rate, that equates to $1.5 million of added interest. I mean, that's a few jobs right there. You could have alternatively done. Right. So something to just keep in mind, and I thought worth mentioning on the show, given that we're talking a little bit about SOFR. But I guess let's pivot back. Is there anything else you would maybe call to this attention as we kind of wrap up the summary of what happened in the last month in the data?
Yeah, there's one more point that kind of showed up, right? And while fixed rate cost of funds had bucked that upward trend, the interesting story is here how liquidity costs have been driven up. We measure the cost of brokered CDs in the background across term structures and compare it to interest rate swaps. This gives us a proxy of liquidity costs, across our population of banks. This liquidity curve of sorts had shown very little movement until the recent Fed hikes. In the last couple of months, there have been rapid increases in brokered CD rates that are driving those costs up. Now, there's evidence that big dollar amounts are being moved here, and perhaps it's the borrowers trying to take advantage of those rising rates for the cash reserves that they might have. I think that this is a noteworthy point to bring up since liquidity costs do contribute to overall borrowing cost. So just as we continue to keep tabs on what is happening with our data, this could be a topic that we kind of put a pin on and see if we see a correlation to coupons in the coming months.
Yeah. So let's talk about what all of this stuff now means for the bankers, right? We gave some advice last time we chatted about this. If you were to wrap it up, how would you be reinforcing your message now if a banker were to call you and ask for some advice?
Yeah, I think I go right back to that conversation and think that our bankers keep on the path. I think that, have options in terms of structure, even if they're just used internally. You may need to react to client concerns on rising borrowing costs, perhaps how much tolerance they have for variable rate debt or other things that might make them worry. So along those lines of if we're looking at a fixed rate structure versus a swap, which option is going to give our client some relief on that borrowing cost while also not negatively impacting the bank on profitability? So like we mentioned earlier during our conversation, continue to encourage our bankers to be curious and to challenge themselves on how they can get that win. You know me for a while. I feel that there is a very thin line, but it's there where a structure benefits the borrower, but also the bank.
Right.
And also, like we mentioned earlier, we've observed with SOFR that bankers are able to win on fees. So just encourage them to lean into that as we are winning there. But other than that, Alex, thank you for inviting me again. Always enjoy this time nerding out over the banking space and catching up, even if it's just virtually.
Yeah, as if we haven't been doing that now for a while. So, no, appreciate it again. It's a great discussion. Deal Dr. Tony Hernandez. I look forward to having you again very soon, and I suspect that it's going to be very soon. More to come on that. So, if you want to catch more episodes of the show, please subscribe to the show wherever you like to listen to your podcasts, including Apple Podcasts, Spotify, Stitcher, iHeartRadio, and more. And if you have a minute to spare, let us know what you think in the comments. You can also head over to Q2.com to learn more about the company behind the content. And don't forget, mark your calendars and plan to join us in Austin in November at the in-person 2022 Bank on Purpose conference. Visit bankonpurpose.com for more information, and you can save $100 off the registration if you use the code podcast. Until next time, this is Alex Habet, and you've been listening to The Purposeful Banker.